Well, how's it going, friends and family? It's time for another portfolio roast session. And by the way, these are real portfolios that are submitted by viewers like you. So if you want to give it a go, you can use the Google Forms link that's going to be in the video description and in the pinned comment itself. By the way, if you zoom in and take a look at my eyes, I have bags under them and it's blue. I probably got like 3 hours of sleep last night, so I'm feeling it. But I think this one's going to be really exciting, and I think we can learn a lot. So in this video, we're going to look at the portfolio as it stands today. We're going to walk through the main concerns and questions behind it, and then it's a 2-for-1 special. In the second half of the video, I'm going to be doing a deep dive into one of his holdings, Hess Midstream, ticker HESM. If that sounds good with you, let's go ahead and get into it. So today we're looking at Nick Hill's portfolio. He's a 46-year-old physician. He has 2 golden doodles. He wakes up at 4 a.m. to go running. And like most of us watching the video, investing in stocks is his most favorite hobby, outside of pooping at work on company time. In fact, he says that he's a student of Warren Buffett. So when we take a look at his portfolio, you should try to see if you guys are share owners of the same company. So with that out of the way, keep in mind, none of this is financial or personal advice. This is all just for fun, okay? I'm talking to myself. I'm delusional. I'm a little crazy. Is that okay? In all of its glory, what you see on your screen right now is Nick Hill's portfolio. For a lack of a better phrase, it's doing a little bit of everything all at once. It's kind of like Taysom Hill with the New Orleans Saints. Across all of his various brokerage accounts, there are 69 different line items. That's a lot, okay? Once you strip out the overlap and the duplicates, that still leaves 46 unique positions. And the total valuation of his net worth in equity is $225,000. Now, for portfolio roasts, due to time constraints and my personal limitation, we only evaluate up to 25 holdings. But Nick Hill boiled it down to just 8. However, I thought it would be helpful for all of us to see all 69 of his positions, so you understand where I'm coming from with my commentary and opinions. By the way, if you see me doing an exaggerated tongue sticking out thing, it's because I have a speech impediment where when I pronounce my TH words, like with, it usually goes like that, but I'm trying to retrain how to talk properly at 35 years of age. It's never too late to do self-improvement. So what's the goal behind this consolidated portfolio? He wants to quit the rat race as soon as possible. Yes, that's coming from a doctor. He wants a portfolio that generates at least $100,000 a year from dividends. And in a perfect world, he wants to see a portfolio valuation of at least $3 million. So when you take a look at the math, it's like a 3.3% dividend yield, somewhere around there. And then let's talk about his strategy. How does he plan on achieving the goal? On paper, his strategy, it's to gather a family of compounders, while at the same time, it's basically a barbell strategy. He has some stable, established, mature companies like Altria, ExxonMobil, but then there's also the high-risk, high-reward companies like SMCI, Tesla, Nvidia. And most importantly, he doesn't just buy at any willy-nilly price. He's strategic and he does tactical buying. He only buys on the dips or when there's a market-wide sell-off. So in a nutshell, this is not a hands-off portfolio. It's very active, there's a lot of trimming happening, and there's a lot of action. And I guess one can make the argument that it's not a beginner's portfolio. It's not beginner friendly. There's a lot going on, and the stocks that are inside of the portfolio, they're being asked to do everything all at once. So on a high level, what are my thoughts and opinions after taking a look at this? It's exactly what I just said, right? It's a little too much going on. I think the process makes sense on a high level, but the execution, my friend, don't take it the wrong way, but it needs to be simplified. And this might be an unpopular opinion, but there needs to be a reduction in the amount of holdings. And I mean that dramatically. I think the investing philosophy that Nick Hill shared with me, it's coherent and it's not bad. It's just there's too many ideas that are competing for attention. And in this case, as capital, it's all over the place. So not exactly a fan of what I'm seeing. Like individually, I think there are some fantastic names represented. But when you put it all together, it's really messy. So instead of boiling the ocean, we're going to assess the 8 stocks that he's most unsure about. Should I sell out of them? Should I double down? Well, what you see on your screen right now are the 8. We're talking about Google, ASML, United Health, Nvidia, JP Morgan Chase, Apple, TSM, and of course, Tesla. And then I have them prioritized by their weighting, how much money he has invested into them. And instead of doing a dedicated deep dive for each one of the 8 stocks, I went ahead and evaluated them based on whether or not they're aligned with his portfolio's goal, which is ultimately to compound into $3 million in valuation by being a world-class, high-quality company that has an economic moat that's as wide as your ex-wife's waist and by nature exhibits low volatility. So let's start from the top. With Google, easy S. I get it. Right now, they're at all-time highs in terms of their valuation. I would argue out of this entire list, easily, hands down, you don't even have to be a rocket scientist to understand with Google, it's a buy and hold. And when I say that hold part, I'm not talking about for the next 2 years, 3 years. I'm talking about that position in Google. Whoever's going to inherit your portfolio after you croak, they're going to be thankful for. I think it's a buy and hold. And it's easily the type of company where you buy the dips because they're so high quality. The next one is ASML. Look, right now we're in unprecedented times where there's this huge surge of AI spending because chips need to be made in order to support the LLMs from OpenAI, Amazon, Microsoft. And if you just got into investing, it's hard to imagine a world where semiconductor chip stocks and players and manufacturers, they're not best in class, right? Because that's all you've ever seen and known. However, do keep in mind that semiconductor chips historically, up until like 2022, there's highs and lows depending on the market cycle. You don't need to constantly be refreshing, buying out and replacing the chips that you're already utilizing. And I think that's why the AI bubble narrative has some merit to it. Because right now, Microsoft, they're about to spend billions of dollars buying out the next generation of Nvidia chips that are state-of-the-art. But also I think Marvell is building out some custom chips for them as well, and also with Broadcom. But needless to say, if they're going to be spending billions of dollars to buy those chips, who's to say that in the next quarter or in the next year, they're not going to be outdated and are not best in class when it comes to supporting the next stage of the AI movement? Right? So as a business leader, you're at a fork in the road. Do you go to the left where you try to do what you can with the previous generation of chips? Or are you going to be constantly replacing your chips so that you have the latest and the greatest and the newest semiconductor chips supporting your LLM? Now, if that's the case, they always go to the right path. Then ASML, they're going to thrive. By the way, ASML, Lam Research, and I think Applied Materials, those are the big 3 semiconductor chip manufacturing equipment sellers and producers. You can't make the chips unless you have your picks and shovels, right? So those are the ultimate beneficiaries of this AI hype movement that's happening right now. So for the time being, I think right now we're at a market high for the semiconductor chip space. I don't see it slowing down, at least not for the next 2 to 3 years, right? But do keep in mind that when we're out of cycle and companies start slowing down in terms of producing or manufacturing chips to get the newest and the latest with such demand like they are right now, ASML will suffer in sales. I'm not trying to say that it's a terrible company. I'm just stating the facts that historically, semiconductor chips, the manufacturers or the chip makers themselves, it is cyclical. But right now, we're in an AI bubble where spending is just going in a circle between the big companies, right? So that one, ultimately, I had to give a B. I think once it does go out of favor, the valuation's going to drop fast and it's going to drop hard. Who is to say when it's going to happen? I do not know. Moving on to the next one is United Health. This one, they're in a sticky and a hairy situation right now because by all regards, financially and fundamentally, it's a high-quality dividend compounder with cheese. But they're running into margin headwinds because medical costs are going up by 10 to 14%, but their reimbursements and the pay rate from the government, it's only going up by 0.09% as it stands right now. Now, obviously, United Health, Humana, Elevance, Cigna, they have about 3 more months to lobby in DC in order to get that reimbursement rate increased to at least like 2 or 3%. Having said that, in the short run, they're going to suffer, right? I cannot predict the future, but based on what we're seeing and what United Health is telling us, by the way, do I need to do that for United Health? Anyways, they're going to be trading sideways, most likely in 2026. But over the long run in the landscape of health insurance and in America's broken healthcare system, I think they'll be okay. Easily a compounder in like 3 or 4 and 5 years from now. 2026, going to be rough. So I put them as a B-. Previous to them crashing 20% overnight, United Health, by all regards, was easily just a solid B. The next one with Nvidia is the exact same situation as ASML, except they face fierce competition from Broadcom, AMD, Marvell, and all the other chip companies that want to do what Nvidia is doing. But for the time being, they're best in class. There's nobody that can make AI chips as good as they can. But Nvidia, historically, in just the past 5 years, very volatile. The highs are very high, but when the sell-offs happen, for instance, when the party in power talks about tariffs too much, and then China retaliates by saying, okay, fine, we're not going to buy any of your chips, companies like Nvidia and AMD will suffer greatly. But if the relationship between the US and China all is well, I don't see why they shouldn't be thriving, at least for the next year or two. The rumor on the streets is that China's LLMs and all of their AI endeavors, they're able to catch up by using inferior chips. Who is to say if that's going to pan out or not? For the time being, if you're Meta, if you're Amazon, if you're Microsoft, you're going to want to buy the best chips, and that's going to be coming from Nvidia. A case can be made for AMD, but they're clear in a distant second place. The next company is JP Chase. Listen, I made a video talking about how the banks were going to thrive under the current administration. And they're thriving, they're flourishing. The stuff that used to hold them back, the red tape, no longer the case. So if you have to have exposure in the financial sector, that gives you a little bit of credit cards, that gives you a little bit of mortgage loans, that gives you a little bit of everything, why not go with the best in class? It's JP Chase. Clearly an S. Clearly a buy and hold forever. Now, the next administration might not be so friendly, meaning the banks could go on a sell-off. But over the grand scheme of things, if you just zoom out and take a look at JP Chase's stock price for the past 50 years, there's highs and lows, but over the grand scheme of time, they compound. Easily a buy and hold for me as well. Next one is Apple. Look, when you compare them against their peers in the Mag 7, yes, their revenue is slowing down and they're not as sexy, but I don't think that's a problem in the context of the portfolio's goal and vision. Slow and steady wins the race. Time and time again, don't bet against Apple. They will find a way to stay relevant, they will find a way to increase their free cash flow, and they will find a way to further their economic moat. Case in point, when we think about the ecosystem moat, I don't think there's any company that does it better than Apple. Because once you get integrated into their ecosystem, you're most likely going to double down and get more Apple products. Because with an iPhone, what goes best with them? An iPad. And if you're going to get an iPad, you might as well get an Apple Watch. Once you get an Apple Watch, what are you going to do next? You're going to get Apple TV. The list goes on and on. And I know it's human nature not to be patient. And when you see their peers crushing it 20, 30%, whereas Apple might be lagging behind, that might cause you to hesitate and be like, I'm cutting ties with you. But historically, the Mag 7, they do take turns outperforming one another. So, for instance, if Amazon's crushing it in years 1, 2, and 3, and Microsoft is lagging behind, in years 4, 5, and 6, it might flip, and Microsoft might be the overperformer, right? So with Apple, dude, easily a buy and hold. Now, when it comes to TSM, the ones that are actually producing and manufacturing the state-of-the-art chips, my views are pretty much the same as ASML because they're benefiting from the AI-driven spending surge. The difference is the geopolitical tension from China, it cannot be ignored, right? They're headquartered in Taiwan, and China wants Taiwan. And that's why TSM, they've been expanding their operations here in the US, and they're going to be manufacturing more chips based here in the US, which is a good thing in the long run. But also, Intel, man, he's catching up, right? He's not as good as TSM at this point, but that is something to be mindful of, right? And so because of that geopolitical uncertainty, I can't categorize him as an A grade or S. Even though deep down inside, I think he's high quality. I think he's going to crush it. I think he's a compounder. I'll say this, if he was based in Texas or Nevada, easily in the A tier. But TSM's not the type of company where I would want to just buy and hold, knowing that it operates in a boom or bust, all or nothing cyclical type of industry. Right now, they're in the gold rush boom phase. So obviously, that's not when you want to buy. Why buy at the top, right? Like if you bought into them, I don't know, a year, 2 or 3 years ago, fine. Because if the AI bubble bursts, you're going to be caught holding those bags when their valuation were at all-time highs. And it's going to take quite a while for that valuation to catch back up. But given the future, 2026, 2030, 2035, does it look like we're going to be reducing our spending on AI, on LLMs, on cybersecurity, on anything related to the tech space? Personally, I do not think so. So this might be the new norm. Maybe in the future, the semiconductor space, it doesn't operate in a cyclical fashion. And it's just going to be a steady, reliable, cash flow heavy industry. I don't know. But what I do know is historically, the facts are that there's highs and lows and it's a boom and bust type of industry. So I cannot wholeheartedly say that it's a buy and hold forever. Me personally, I would want to jump ship and pivot that capital into a more stable industry. That's just me. And last but not least, we have Tesla. I think this one absolutely does not belong in the portfolio, given the whole idea of wanting to sleep well at night, that the portfolio should be full of companies that are boring, safe, and steady. Tesla does not fit that description. And as a matter of fact, right now they trade for a premium, not because of their fundamentals or financials, not because their gross sales are increasing year over year, but because they have a charismatic leader and due to a future narrative, a hype that they're going to change everything. Matter of fact, this past week, Tesla just reported their earnings, and they talked about how they're going to discontinue manufacturing two of one of their more popular EVs. I think they're doubling down on the Model Y and Cybertruck, and I think one more. But now they're pivoting into making and going all out into the robotics that I talked about in the weekly earnings video, those robots that'll be able to do entry-level tasks like flipping burgers or doing the laundry. All that to say, Tesla's not a bad business. I think their stock, it soars to the moon because of all of the expectations that are being baked in for the future. Me personally, I like to buy into companies that are fruitful and have the numbers to back up why they're high quality. With Tesla, they really don't fit in this bunch. Me personally, I would never buy into Tesla unless they initiate a dividend, if they were able to improve all of their numbers year over year, and most importantly, if Elon Musk decided to stop being political. Once you pick a political aisle, you literally alienate at least 40 to 50% of the customer base. And if I'm a potential business owner of an operation, I do not want that type of association, right? Think about Target Corporation. They used to crush it until they started flip-flopping the political aisles, and now the boycotts are really hurting them, right? Once a company gets associated with a political party, for me, that's when I start to jump ship. And that's why a lot of people jump ship with Disney as well. Do not get political with your business. If you're a small business owner, heed the words that are coming out of my filthy little mouth right now. Do not alienate your customer base. So for Tesla, I give it a C, only because their stock performance is stellar, but it's not based on present tense execution and numbers. So if one of these has to go, it's got to be Tesla for me. Now, I understand some of you watching this video, you might be triggered, you might be foaming at the mouth. You're saying, how dare you say negative things about my beloved leader, Elon Musk? Look, I hear you. But as a guy that really cares about the financials and fundamentals, Tesla just ain't it, okay? Now, let's move on. Instead of our usual portfolio roast format where I go through the scorecard and everything else, like what I would do to modify this portfolio, I thought with Nick Hill's situation, it would work better as a learning exercise for all of us where we directly address his questions, concerns, and his callouts. And the first one is this: how much of a retirement portfolio should be not boring, and what percentage is too much? And the reason why Nikhil has this concern is because he has moonshot bets that can 2x or just go bankrupt overnight, right? So I personally do not think that anyone over the age of 21 should be doing day trading or active trading because, believe it or not, I think it's the quickest way to lose your money. Sometimes you might win, and that's enough to give you that delusional confidence and you can pull it off again. But let's look at the facts, okay? Is day trading profitable? We're on Investopedia.com. Now, according to a study in Brazil where they followed 1,600 day traders, 97% of them lost money. And it's not just the Brazilians that are losing in the day trading game, okay? A similar study in Taiwan found that a majority of the people that are doing day trades, meaning you buy into a stock on Monday and you try to sell out of them tomorrow on a Tuesday, that's what I mean by day trading, or buying into them Monday morning and trying to sell out of them by lunch. Less than 1% of the most profitable day traders go on to have good returns. And 99% of the people, right? And then active day traders in the US, they underperform by an average 10.3% annually. So when it comes to these moonshot bets that have a time horizon of like a month or maybe even like a 1 year, I think Warren Buffett said it best when he said this, okay? If you aren't willing to own a stock for at least 10 years, then you shouldn't even think about owning them for 10 minutes. Because I talk about it on the channel here and there, but when it comes to the stock market, we really need to stop thinking of them as just a ticker symbol or as just a stock. But instead, you need to adopt the mindset of, if I buy into this, I'm fundamentally a share owner of that company, which means I'm a part owner of the company. Or to give a better example, would you really want to buy a dry cleaning business and then just try to sell out of it 2 days later? Probably not, right? Because when you buy a business, you want to operate it and see if it's fruitful and compounds, for the next 2 or 3 years. So by changing our mindset from doing these moonshot bets or day trading or active trading, fill in the blank, and switching it over to a long time horizon, I think it's a value add for everybody because then you start to ignore the daily market noise, the volatility. You're not really going to care if you're holding in Amazon or JP Morgan Chase, if it's down by 4% today, because in the grand scheme of things, does it really matter? Right? And if in the future it's going to go up by 50, 100 to 200%, what's a 4% drop off today? Right? But when it comes to day trading or moonshot bets, we start to feel the anxiety. We start to feel the negative emotions tossing and turning in our stomach like, oh my gosh, should I panic sell? But with a long-term horizon, with money into high-quality compounders, you don't really get that. Right? So if the business fundamentals are intact and the investing thesis as to why you jumped in, it's still true, then leave it alone so it can compound. Likewise with the dry cleaning business or any positions or stocks. So you can see that I'm not a day trader. I'm not an active trader. I'm an investor. I think there's a fundamental difference between the two. A trader just wants to make a quick buck based on the stock chart graphs. An investor, they're in it for the long run, through the rough wind, the rough seas, the highs and the lows, because by staying in the ship, you'll reap the rewards 5, 10, 20 years down the road. And if it's a dividend payer, you'll be collecting a paycheck. They'll be paying you rent money to be a part of your portfolio the entire time. Now, granted, I think if it's like less than 1% of the portfolio, so if you have like $100 and you're only allocating like $1 to moonshot bets or to these experimental plays, I don't think it's the worst idea in the world. And I guess we could even push it up to like 5%, especially if you are a high income earner like Nikhil. If you're clearing easily $400,000, $500,000 a year and you have a lot more disposable income, I guess you can, go into that 5%. But for most of us, stay clear and stay away from active day trading, moonshot bets, these booster strategies. No bueno. Sometimes it works, and when it doesn't, you lose your money. And that's why if you only allocate 1%, if you lose the money, it's like, okay, well, I got burned here. When you go 100% all in into moonshot bets, I mean, yes, it could 5x, but we always need to tell the other side of the story. You could lose everything as well. You could lose everything. And I feel like that's what people should focus on instead of the prospects of 5xing. But Amos, you're being such a hypocrite because I know you do moonshot bets as well. Yes, rules for thee, but not for me. I myself, I do invest into moonshot bets, but I only play with asymmetric growth stocks. Stocks that have a high ceiling and a pretty stable floor, meaning there's not much more room for them to drop in valuation, but there's a ton of potential, 3, 4, 5x in terms of their ceiling. And the next question is absolutely difficult, and it's almost impossible to answer in a correct format because depending on the person, gender, if they took a dump today or not, or if they're stuck in traffic, the answer varies. It's how and when to trim risk without killing the compounder. Because have you ever heard of that phrase before, to let your winners ride, why punish them? And to be fully transparent, I think I'm the worst person to ask this question because I sold out of Palantir, AMD, Nvidia, and Google way too early. Then again, on the flip side, I'm the same guy who bought into them when they were undervalued and trading at like 1 or 5 year lows. So at least I still capitalize on 40, 50, 80% gains. But I wish I would have held on to get 400% gains. But whatever. A general rule of nipple is, let's say I put $10,000 into a stock and I let it bake, marinate, and it just cooks in the oven for the next 3, 5, 6 years, and it grows to a valuation of like $24,000. What I would do then is sell $10,000 of that position that's up into the green. That way I can get my money back to what I invested into it, and the rest, I'm playing with house money. But I would only do that if, based on my calculation, they're way too overvalued. And I'll go into depth here in a little bit. Or I might just sell out of everything if I think a pullback or a correction is pending. Kind of like when we talked about ASML and TSM. Like if I know that the semiconductor chip space is facing a bear market or a downturn year where the inventory of chips, like what if one day Microsoft wakes up and they realize, I don't think we need to refresh our chips to support Azure and our AI models. I think we're going to be fine. We're not going to buy more chips. And then Amazon adopts that philosophy and Google adopts that philosophy. These chip makers, they will go on a massive sell-off. Now, I'm not trying to insinuate that's going to happen, but that is also a possible scenario. So circling back to selling out, if I think there's a pending correction about to happen, they're way overvalued, and their RSI is above like an 85 or a 90. And when I say overvalued, I'm talking about if a stock price reaches about 25% above their fair value, then there's a little bit of a disconnect between their fundamentally based stock price and the market just pumping their money into them. There's a lot of emotions and narrative being hyped into them. Case in point, Tesla. But I think we should pump the brakes and ask the question, why are we even selling in the first place? Because we just talked about it, right? As long-term investors, we really shouldn't be selling out of our winners. Why punish them if they're doing all of the heavy lifting, right? I learned that lesson again and again and again with the Palantir, AMD, Nvidia, Google, the list goes on and on. I always sell them too soon. I think a valid reason as to why we're thinking about selling is because we need that capital right now. Because you need it for a down payment, for a new mortgage, or you want to pay for your kids' tuition at a private school that's giving them a very questionable education. But jokes aside, that's why I think it's so beneficial for everybody that's watching this to have an investing thesis as to why you buy into a stock. Have a framework, have an analysis so you understand why am I buying this and when I plan to sell it. For some of us, we won't sell. For most of us, we will sell. So you should have a good rule of thumb instead of just panic selling when a company experiences a random 7% drop in a single trading day. I'm not trying to be the crazy guy here, but when it comes to buying a very cheap Chinese gadget on Amazon, dude, we'll be reading through the reviews, we'll be looking at the photos, we'll be doing all of that before we pull the trigger on something that's like $15. But what I'm trying to say is, why can't we devote more time into something like owning a freaking business? Right? When you buy a stock, you're essentially becoming an owner of that business. So why don't we dedicate more effort and energy into figuring out whether or not it fits into our investing thesis, like our philosophy and our portfolio's goals. So having said that, I think you can see that I'm very biased. I think the buy and hold strategy, it pays dividends in the long run, quite literally. As long as the business in question is high quality, I think you're going to be good to go. Now, obviously, for some of us, we have a survivor's bias where it's like, dude, I sold out of that company before they went 50, 60, 80% into the red. But then that begs the question, were they ever high quality in the first place, right? Usually high quality companies, even if they do experience like a 20, 40, 50% drop, like everybody did in April 2025, with due time, they recover. Hello, Google. Hello, Microsoft. Hello, Meta. Despite the sell-offs, in the long run, you'll be fine. But to be the devil's advocate that's on my shoulder, if the business in question is a piece of crap, a cash-burning dumpster fire, or operates in a cyclical space, then you got to ask yourself the question as to why you bought into it the first place. Think about it, right? Would you want to buy a laundromat or a maid janitorial services company if you knew that it was unprofitable and had no economic moat and the employees are disgruntled with the leadership? Would you want to buy into that? Probably not, right? But when it comes to stocks, some of us get it wrong. We only look at the PE ratio, or we only look at the stock price. Like, dude, it used to be $100. Now it's $15. I think they're undervalued. No. Dude, you have to look at the financials, the fundamentals. You need to look at their position in the market that they're trying to serve. Is it downsizing? Is it in a bull run? You got to figure out, why are they going on a sell-off? More often than not, they're selling off because they're a piece of crap. And I'm not trying to say that to be rude or to be mean. It's just what I have found to be true time and time again in the market. So to give a tangible example, let's go ahead and assume that I bought into Palantir about a year ago at $40 a share. And now, depending on the mood of the market, roughly $150, $160 a share. I practically 3x'd my money. On paper, let's go ahead and assume that my calculation says that Palantir's worth $110 a share. When they're at $150, $160, they're overvalued by a significant margin, right? And what's happening right now? Microsoft's getting sold off as if they're a piece of crap company. They're getting the exact same treatment that an unprofitable dumpster fire gets. Going down 12% on a single trading day for a company as high quality as Microsoft, so you're thinking it's a great bargain. Then I would argue if you have limited amount of capital like I do, then it makes a ton of sense to sell the Palantir and to pivot that capital into a compounder that has more of an upside. Does that make sense? Because Palantir, they're basically trading at all-time highs right now. Whereas Microsoft, dude, I have their fair value at $600 to $625 a share. They're about $200 below that. I would argue Microsoft's undervalued. But this video is not about Microsoft. So when it comes to selling, it makes sense if the reason is justifiable. But if we're just selling for selling's sakes, a loser's game. That's how you lose your money. And I say that because you might jump ship before the inevitable rebound or the relief rally. And I'm sure some of us watching this video, we have our own experiences and stories of where we jumped ship a little too soon. Matter of fact, I have a play-by-play guide on selling and when to sell up on the Patreon if you guys are interested. I mean, right now we only talked about, like one example of when it makes sense. But if you want to see all of the various scenarios with examples, it's on the Patreon. And while we're on the topic of when to sell and just being patient, even outside of the realm of the stock market, in life in general, compounding happens over the long run. That patience pays off. That delayed gratification. Dude, my life experience and my path led me to meet some of the most remarkable human beings. I used to have one-on-one coffee chats with the current CEO of Domino's Pizza, Russell Weiner. I also had the privilege, because of my military academy background, of interacting, shaking hands, and getting to know 4-star generals. And do you want to know what these successful individuals all had in common? It wasn't talent, it wasn't their good looks, it wasn't how they talked, it wasn't just passion. They had this relentless mental fortitude, perseverance of never giving up, always taking the consistent steps to show up every single day without fail. Even if you're going through a scandal, even if you had an argument with your spouse, even if you had just a bad day in general, doing the right thing every single day consistently. And I say that because a lot of the individuals that I know that have so many regrets in their life, by the way, my former life, I used to work in ministry as a pastor, so I understand this, okay? Human psychology. The people that live with a lot of regret, do you want to know what they share in common, the traits and the qualities? They quit way too early. They give up on themselves, and they only want shortcuts. They only want to see results right now. And I think that really permeates into the stock market as well. Some of us, we don't know what it's like to play the long game, to be patient, to show up daily, to set a long-term vision, and then to execute to get there by taking the small steps every single day, doing the right thing and going towards the right direction. And to be honest with you, if you think I'm just talking about in the career space, you've got it all wrong. This is also really important and a priority in the relationships that are in your life. If you're married to someone, you want to show up every single day, love them, honor them, and respect them day after day consistently. I'm not talking about showing up out of the blue with just flowers one time. No, do the right thing and the good thing and love them every day. Now, the next concern that Nikhil has is around the topic of diversification, or in other words, diworsification. So at least he's cognizant that he might be doing a little too much. This might be an unpopular opinion, but when I was pursuing my MBA in the academic realm, they teach us that diversification is the way to go because it diversifies away your risk. Because if one sector or industry, crashes or tanks, at least your other ones keep you afloat. But as I have been far removed from the academic setting and from a corporate setting, let alone, I'm starting to learn that diversifying, not really the way to go every time. Hear me out, okay? And that's because I'm a firm believer that less is more. Diversifying for the sake of a checkbox, I think that's a negative value add. And that's the way I used to invest, right? In the past, even if I wasn't feeling that rosy feeling in my stomach about a business, because I didn't have that much exposure to a certain industry or sector, I would buy into it. That way I had all of my bases covered. And I learned that that would only yield a market level of a return. So if the S&P 500, their ROI was 10% that year, my portfolio would also be 10%. That's when I realized, I don't really like it. And besides, I don't believe in owning the index if the index includes businesses that I don't really like, I'm not bullish about. And that's why, for me, personally, you will never find oil and gas, pharma, for-profit prisons, airlines, car manufacturers in my portfolio. Actually, that was a lie. I am invested into one pharmaceutical stock, but it's not for humans. And I will go ahead and reveal that company in my weekly series that I'm launching here in a bit. But having said that, I would rather concentrate my capital where I have really high conviction. Okay? I don't need to diversify my money into this, just because I have to. No. So in terms of a portfolio breakdown, again, unpopular opinion, but I don't do bonds. I know in the Jack Bogle universe, like if you're a bogglehead, it's a key ingredient, right? You need to have 20, 30, 40% exposure into bonds. And then if you're in retirement, you want that to be even higher, 50, 60%. But for me, bonds are they're no bueno. And to portray the point that I'm trying to get across, let's take a look at your screen right now. This is going to be a hyperbole, a very extreme example, but I think we'll start to understand my mindset. Let's go ahead and assume that the diversified portfolio, it consists of 50 different stocks, a 2% allocation into each stock. It adds up to being $100, which means you have $2 invested into each stock. Now, let's go ahead and assume that stock number 4 in the diversified portfolio, it goes to the moon. And somehow it 10x's. If that happens, then the $2 allocation, it grows to $20. So for stock 4, dude, you're probably really happy and you feel like you're a genius and you're thinking about doing YOLO into options, calls, or puts. Stay away from options, okay? For the average person, options, way too complicated to win consistently. If you're a seasoned investor, I think options are probably one of the best ways to create a synthetic dividend. But anyways, that's neither here or there. So if that is the case, and one stock compounds and it 10x's, then the total portfolio valuation changes from $100 into $118. You might be like, wait, isn't it $120? No, because we're going to go ahead and assume that the other stocks remain $98 because they're $2 a piece. So if you do some napkin math, your portfolio's valuation is going from 100 to 118. Super easy, right? The ROI is 18%. But on the other hand, let's go ahead and assume that you have a high conviction portfolio like I was trying to assert and support and encourage. So you only have 5 positions. And I went ahead and gave them some silly names. It doesn't really matter. And similar to the diversification portfolio, you have $100 that you're working with, and you break it down equally across the board. A 20% allocation is what? $20 into each stock, okay? We're going to go ahead and assume that leftover lunch, it 10x's as well, which means the $20 you invested into leftover lunch, it transforms into $200. The huge difference here, friends and family, it would effectively go from $100 into $280. That's why I advocate for the idea that spreading yourself thin is no bueno. When you spread your capital across too many different stocks, even if you do have a winner, you're not really going to feel it. I mean, you will, but it'll be very insignificant. But if you're more selective, picky, and the lens in which you analyze and scrutinize a potential stock, if it's really, really strict, I think that's a good thing. I think too many of us were willing to turn blind eyes to obvious and immediate red flags of a business just because of the dividend yield, or just because of the PE ratio, or just because of fill in the blank. But most of us, if we were to operate being very strict as to which businesses we want to buy, it would look more like the high conviction portfolio. Now, obviously, keep in mind this is coming from the perspective of prioritizing total return. For some of us, the one on the left would be better, right? But most of us, we would probably prefer the one on the right. That way our portfolio's valuation can grow bigger and compound at a faster rate, which I would argue in Nick Hill's case, that should be the name of the game, the one on the right rather than the one on the left. And that's why earlier I kept saying less is more. He has way too many holdings, and that's why I wanted to use this example as a learning lesson for everyone. Because he wants a $3 million portfolio, and it's currently $225,000. So by going with the one on the left, this method, it's going to take a while. And what do I mean by high conviction investments? It's companies that you believe in with 110% certainty. Even if everyone else says, oh, that's a piece of crap, they suck, because you analyze them and you put them to the test, and you looked at their numbers and financials and data, you know for a fact it's a really good company. Like, you might be the guy that works with that software or product or tool every day. So when people talk smack about it, you would be like, no, I actually know from firsthand experience it's really good. Plus the numbers and data align in that it looks phenomenal. But more importantly, high conviction picks, they should also be aligned with your portfolio's strategy and companies that you are willing to stand by with and hold them, as they're crying when the market crashes or the market gets it wrong. Personal preference, but I would just go with the best house on the block. Why bother trying to buy the little shed that's on the corner or the other 5 homes in the same neighborhood? Just go with the best house. Does that make sense? Some of us, we try to diversify to the point where it hurts us. Like, why buy the 10 other stocks in the same space when you could just go with the best one? The best in class, the one that you already know. All of us, it doesn't take a rocket scientist to understand who's actually the best in an operating landscape. When it comes to banks, when it comes to water utilities, when it comes to insurance stocks, and the list goes on and on. We all understand which one's the best of the best. So I don't know why people bother with the ones that are in the F tier or D tier or the ones that are below average. Like, why do that to yourself? And on the topic of diversification, I think this one's worth calling out, so pay attention. This is where you also don't want to go 100% balls deep into just one sector. Because imagine if your entire portfolio was just Elevance, Molina, United Health, just health insurance stocks. The other day, your portfolio would have been in the red by 20, 30% in a single trading day, right? Or imagine that your entire portfolio was just General Mills, Conagra, Flowers Foods, Campbell's. Your portfolio would also be bleeding deep into the red. Or similar to a popular YouTuber, if your portfolio is predominantly SaaS, software companies, you would also be deep into the red. And that's why I think when it comes to diversifying, balance is the name of the game. Balance. And that's why earlier when we were looking at the 8 stocks, I think as of right now, Nikhil's portfolio skews really heavy towards the AI chip building space, only according to the 8 that we see right here. Obviously, there's 69 different positions, but that kind of tells you, right, if there is anything happening to the AI space, like I said earlier, right? If somebody walks into your corporate building's lobby and lets out a fart and the security guard smells it and he faints, and that's enough to send the entire industry into a sell-off, you're going to be really hurting, right? And that's why if, for instance, you have a 5-stock portfolio and you want to be well diversified, can't go wrong with like Amazon. It gives you exposure into pharmacy. It gives you exposure into e-commerce, retail, digital advertising. And then we got JP Morgan Chase. Gives you exposure into investment banking, credit cards, debit cards, loans of all different types and flavors. You got Berkshire Hathaway, another conglomerate that gives you exposure into almost everything, including my favorite running shoes, which is Brooks. And then number 4, we can entertain the idea of Google. That'll give you exposure to anything and everything that's developing in the AI landscape, but also best in class when it comes to digital advertising. And then, of course, to balance it out, to give yourself a little bit of real estate exposure, go with the best. Real Estate Income Corporation. I would argue those 5 stocks together in a portfolio, I would smile from this year to this year. Best in class businesses for whatever territory that they're operating in with a wide economic moat. Every single one of those 5 stocks would be in the S tier given their industry and sector. Obviously, if you compare Realty Income Corporation to Nvidia head on, not a fair battle. But if you compare Realty Income Corporation to another REIT, I actually uploaded a video that breaks down the entire real estate industry. They come out on top. I will caveat that by saying, how less is more tends to be better for almost everybody. For a retirement passive income portfolio, a portfolio that's meant to generate an income for you so that you can live off of it, I think a higher number of holdings, it would make sense. That way, systematically, the dividend payouts, it could add up to giving you a dividend into your brokerage account every single week or every single month from high quality payers. That would be a good, coherent, and a solid strategy. I think it's trying to do too many things at once. Now, if you don't care and all you prioritize is the dividend income, then obviously what I just said goes out the window. Dude, I would just keep it simple. Like 2 or 3 ETFs and just call it a day. I think by messing around with so many various stocks, some of these names are good, I'll admit. Am I crazy when I say that? Case in point, take a look at this. With $10,000 invested into SCHD and SCHG in January of 2016, obviously I allocated 25% to SCHD because given my age and parameters of being 35 years old, I should be prioritizing growth, right? If I scroll on down and show you what has happened in the span of roughly 10 years, the 10 grand would have turned into 47,500. The CAGR, how much your money grew by, is 16.8% year over year. The S&P 500, exact same time period, 14.7%. So by keeping it simple with 2 ETFs, you would have beat the market. By messing around with different stocks, trading in and out, selling, trimming, doing all of the convoluted strategy, the more active and hands-on we are with our portfolio, the more money we lose. For the amateur investor. Now for hedge funds, for the big billionaire investors, obviously not for them, right? They move in and out of stocks almost every single day, but we're not them. So I'm not trying to tell anyone else what to do. But if this were me, I would slowly make the conscious decision to move away from individual stocks altogether and just go with ETFs. Stop it with the FOMO, stop it with the strategies, look at the facts and the outcome. Okay, is everything that I'm trying to do, all these various levers that I'm pulling, does it add up to something that is good and fruitful? Or is it negative 50% total return all time? And I don't want to come across as being too harsh or throwing mud on Nikhil's, Tesla parked in his driveway, because I'll say this right now. For some of us, the delusional, the crazy people, we can do it. We can manage a brokerage portfolio that has 25 or even 50, 75 positions. Now, although it's not for everyone, I think Nikhil is proof that if you have the dedication and the discipline to stay on top of things as an informed investor, you can beat the market. That's going to take time, and you're most definitely going to have to tune in to the earnings calls to figure out what the heck is going on, the landscape, the forward trajectory, and all of that. But hey, I think if the result of maintaining a portfolio of individual stocks, it allows you to beat the market by a significant margin year after year, wouldn't you say that it's worth all of the work? And for freaks like me, it's a really fun hobby in which you can make money, not only from the capital gains, but from the dividend payouts, right? So if you're wondering on why the switch up in my tone, because prior to this, I was like, hey, you gotta go with simple, you gotta go with passive investing. Dude, it's because for the bulk of amateur retail investors, that's probably the best path forward, right? That's not financial advice, but it's just the reality for most people. But anyways, I'm not trying to be the bad guy here. What do you guys think of Nikhil's portfolio, but more importantly, his strategy of trying to dabble into everything, right? The AI bubble, crypto, dividend income stocks, growth stocks, and everything far and few between. Let us know in the comments section. Now, with that said, let me take a quick little break, and we're going to be analyzing and doing a very succinct analysis on Hess Midstream. And as you take a look at your screen right now, ticker symbol HESM, $36. By the time you watch this video, they could be $35, $34, they could even be $38 a share, but somewhere in the mid-30s. How old I am, actually, that's kind of funny. Past 1 year, negative 14%. Past 15 years, 72% into the green. Okay, so the sell-off right now is happening, but they are recovering year to date, 4% into the green. What exactly is Hess Midstream? And I think to understand what they do properly, let me paint the landscape of the oil and gas field, okay? So in the oil and gas industry, there's upstream, there's midstream, and there's downstream. Upstream companies do the drilling and extraction of the oil from the ground in places like Texas, or I guess now Venezuela. Examples include EOG Resources and ConocoPhillips. Midstream companies like Hess, they do the transportation, the processing, and storage of the oil. And that's why I wanted you to look at it visually. So after the upstream companies drill that oil out of the ground, the midstream companies store it, they transport it. And so in the context of capital expenditures, their bread and butter in the midstream, it's going to be the pipelines and storage tanks. And then the downstream companies might be intuitive, but they're the ones that refine the oil into usable products like Vaseline that you rub on your bald little head so it's a little shiny, I don't know, gas for your 1998 Honda Civic, or even for jet diesel fuel or whatever. So you've got companies like Sinclair, Phillips 66, or even Valero that does that, okay? And then there's also integrated oil players that do everything, top to bottom, like ExxonMobil and Chevron. Here's the differentiator. Unlike upstream companies who live or die by the daily price, fluctuations of oil barrels, for midstream companies, they operate on a fixed fee contract. So when I thought about it, I was like, wait, hold on. So they're kind of like a toll booth operators. They're kind of like the Visa and MasterCard of the oil and gas world, because they get paid regardless of the oil barrel is $30 or even $80. They still get paid. As long as there's oil moving through their pipes, they're going to get paid. And now let's go ahead and talk about the cheese situation, the things that you want to take into consideration. Before we get to that, you want to know what's kind of crazy? I just realized that I spent 26 hours working on the analysis of the portfolio, deep dive into Hess, and by the time I get done filming and then editing, that's probably going to add another 7 or 8 hours. That's a lot of work for one video. So if you guys could do me a solid and click like on the video, I would appreciate it a lot. So the first thing is the juicy dividend. I think depending on the day, their dividend yield goes from like 7 to 9%. And that's because their dividend payout increases every single quarter. And that's because they're profitable beyond belief. We'll take a closer look at their numbers towards the end of the video. And this includes during the pandemic. They did not cut their dividend. So when people talk trash about dividend stocks, they're meaningless and they cut the dividends, point them in the direction of Hess. I think it looks phenomenal. And I wasn't exaggerating when I said that they increase their dividend payout every 3 months. And that's because for an established, mature industry like moving and storing oil, you can't really change the trajectory of your growth by going all in, R&D or marketing advertising campaigns. It's not going to be fruitful to ROI. That's why for Hess, it's smarter and better to reward the shareholders with excess capital. Because if you know they're going to pay a juicy dividend, people seeking that are going to jump into your stock. And then the second call out that I have about Hess is their CapEx situation. So oil and gas, like I just talked about in the introduction, there's a crap ton of capital expenditures. So free cash flow is not a metric you should ever look at when you're evaluating an oil and gas player. Likewise, utilities, free cash flow makes 0 sense. Likewise, with REITs, don't even go to the cash flow statement because you're going to look at the free cash flow and be like, ew, it's gross. For a REIT, you want to look at the adjusted funds from operations, the AFFO. That is the proxy for the free cash flow. Now, having said that, for 2026, Hess, they're projecting only $150 million of CapEx. I think that's huge, like a good thing. For reference, in 2024, their CapEx was $306 million. If you're wondering why I'm calling this out, it's a good thing for CapEx to be decreasing, because usually with metrics and fundamentals, you want to hear the number getting bigger every year. Not in the case of CapEx, not in the case of stock-based compensation, and obviously not in the case of shares outstanding. You don't want to see that bad boy be growing. The third call out that I have, now this is the negative, and it's the reason why they went on a sell-off after they reported their earnings in October, because they're not projecting growth. And as a matter of fact, their gross sales are projected to remain flat. On the bright side, maybe 2% growth. But for the time being, for this year and potentially next year, no. And that's because their biggest customer and majority share owner, Chevron, they're drilling with less rigs for the time being. Which means Chevron, they don't need as many pipelines moving the oil. And when we think about calculating a fair value for Hess, I'm going to keep it short and simple because I'm losing steam. Dude, I've been filming for over 2.5 hours. I'm getting really tired. Cheese value per share is $40. That's what they should be valued at. And currently, they're like $36, $35. So they're kind of off from the mark, but I wouldn't argue they're very undervalued. They are sort of, but not that much. So with a margin of safety baked in, I think a good price to jump in, if I were to buy into them, hypothetically of course, $30.67. I think they reached the low in October of like $31. So they flirted with that, but $30.67. And then the Benjamin Graham's valuation says that Hess should be $31.50. If you marry the two, $40 and $31.50, you get roughly what? $35.50, $36 a share should be their fair value. Lo and behold, that's what they're trading for right now. So I would argue they're not undervalued, nor are they overvalued. So to buy them right now, cost basis around $35, $36. Not the best deal in the world, but I also don't think it's the worst idea in the world because the facts are right now, the global oil demand, all-time high. 105 million barrels are consumed daily. I think that's a wild number. So oil consumption is through the roof, but unfortunately, Hess, they can't really benefit from it because of the contracts that they have with the upstream companies. They're not utilizing them as much, and that's why their CapEx came down as well, because they're like, oh, we don't need to build as much pipes right now. So if I had to make an educated guess, if this oil demand continues, $35, $36, even though that's their fair value per share, who is to say that they can't hit $38, $39, or even $40 a share, right? As long as the oil demand continues. But oil demand is also very cyclical. There's highs and lows. So when it comes to the compounder chart, putting them up against all of the various companies that we have analyzed on the channel, listen, before I reveal where they're gonna go, I don't think that Hess will have market-beating returns. But I think the stable dividend payout is pretty attractive, especially for folks in retirement. Dare I even say, after researching this company, Hess might be top 25 dividend payers if you are retired and you want a stable paycheck. But for total return, dude, Hess does not belong in that conversation whatsoever. So I would argue Hess is in the C tier, right next to Ford, right next to Sezzle, right next to General Mills. It's a pretty odd bunch of various companies. For one reason or another, they're right there. And that's where Hess is. I'd argue that Hess is probably a bond proxy. And at 35 years old, for me, it would make no sense at all. For Bobby, that's 65 and walks around with his balls hanging out at the gym after he takes a shower and just keeps walking around with his saggy nuts, I think it makes a ton of sense. I'm not joking. I do think top 25 for dividend paying stocks, not for CAGR. So let's go ahead and talk about my game plan. Before I do so, man of my word, let's take a look at their numbers together. Actually, they did reach a high of $44, and it looks like they're recovering at a pretty consistent pace, especially in 2026. Like if you bought the dip for $33 and they're $36 now, I think the cost base is solid. If you bought into them when they were roughly $31 in October, solid. November about $32, solid. Having said that, let's take a look at what we are working with. Their gross sales time and time again, except 2015 to 2016. But ever since then, increasing up until the right. And mind you, at a double-digit rate for 2 years in a row. But for that drop-off, that was negative 10%, which is kind of weird. I'm assuming they sold off a part of their business, which is why they didn't have enough pipes, or something else happened. I don't know. I would have to look into their 2016 10K to figure out what the heck happened. Take a look at their profitability. My gosh, that is crazy. Their profits per share is consistently going up. And obviously 2019, fluke year. But one thing that I have to address that I really do not like about Hess is take a look at their shares outstanding situation. Now, obviously, heading into the pandemic, they were buying back the shares aggressively, which I like to see. But ever since then, dude, they've been diluting the shareholders at a very diabolical rate. Talking about like 40% year over year, 61% year over year. And as of recently, they diluted the shareholders by 45% year over year. I really do not like that. As a matter of fact, I know that they have enough capital to buy back the shares because they're growing the freaking dividend every 3 months. So I would argue they need to stop diluting the shareholders. This is really bad and a red flag in my personal opinion. Despite being a mature, established company, why the heck are they diluting the shareholders as if they're some cash-burning startup? That right there is a red flag that I refuse to turn a blind eye towards. That's really freaking bad. The next thing that I want to call out is a metric that's really important when it comes to the utilities, oil and gas players, anybody that has a lot of CapEx, and it's the return on invested capital. Usually you want to see it at 10% as the golden standard, or at a number that's above their weighted average cost of capital, which for Hess is 8.1%. Their ROIC is really juicy. What's not juicy is the trend that it's going down. 22% in 2022, and ever since then, it's just dropping off. I don't like that, but at 20% ROIC, dude, that's phenomenal. But more importantly, with Hess, what matters the most is their dividend profile, because it shows you as a business enterprise, are they crushing it to the point where they're able to increase their dividend payout every year? As a matter of fact, they are, plus some. Right? The dividend yield right now is 8.5%. Annual dividend is $3.06. This is not accurate, okay? You might be like, wait, the payout ratio is too high. The dividend's going to get cut. Okay, as a litmus test, if we jump on over to the cash flow statement and take a look at their free cash flow per share is $6.11. Dividends per share is $3.06, which means the payout ratio is 50% when you take into account the free cash flow. The net income, I'm assuming there's wonky financial manipulation or financial engineering happening, and that's why the payout ratio looks high on a GAAP basis. But in terms of the cash that's coming into the company and then cash leaving the company, 50% of it is being utilized for the dividend. I would argue very sustainable, very healthy, and I can see why the dividend's being raised every single 90 days. I'm not joking. It's not every year. It's every 90 days that dividend payout grows, which I think is freaking fantastic and is really rare, actually. They're not obligated to do so, but they choose to do so. That's why I said, if you're in retirement, Hess makes all the sense in the world. So what's my final verdict? I like this one, but I'm just not interested in the oil and gas stocks, much like the pharmaceutical space, although for different reasons. I wouldn't invest into Hess. On paper, I do think it's a good company, but I do not want them in my portfolio. And I think it's because we all have our preferences in life, right? Like showering naked, or your beverage of choice when you go out to eat. Some of us, that's Coke. For others, it's a bottle of beer or just plain water. I think a really good example is, I think I'm the only YouTuber that talks about military stocks like Lockheed Martin, Huntington Ingalls, RTX, General Dynamics. And I know for a fact that's not for everyone, because you guys are vocal and you tell me like, dude, I could never invest into the military stocks for XYZ reasons, and that's okay. We don't all have to make money the same way. So with Hess, if I was in retirement, they would be in my portfolio. I'm not joking. Who they are right now, I would do it. 20, 30 years down the road, that could change, right? They could be an entirely different business model. Oil and gas, the demand can drop off the cliff. Their dividend might not be sustainable, but who they are today, if I was retired, I would do it. So even though I like Hess, I'll have to pass because I'm nowhere near retirement. And my game plan and my portfolio strategy, you're gonna have to watch the public portfolio series where I go over and analyze my own portfolio. It'll be fun. But having said that, if you're invested into Hess, I can't fault you. I like what I see, it's just not for me. So having said that, I hope you guys enjoyed this 2-for-1 video. I am so tired, physically, mentally, I'm sleepy, but genuinely, it was a fun ride. I hope you learned a thing or two, or it allowed you to think about things from a different perspective. That was the aim and intent of this video. Entertainment purposes only, okay? None of it was financial advice. Having said that, I love you guys. Stay safe. Good luck in the stock market, and I will talk to you really soon.